The biggest merger in golf history has officially ended in a massive financial divorce. On November 18, 2025, Callaway announced the sale of Topgolf, effectively admitting that their $2 billion experiment had failed. Just 4 years ago, this union was supposed to change the sport forever by combining equipment manufacturing with high-tech entertainment to create an unstoppable giant. Instead, it resulted in a valuation collapse that erased nearly half of the brand's worth. This is the story of how a brilliant idea from two British twins conquered America, only to be dragged down by debt, identity crises, and a corporate marriage that never should have happened. The story begins far away from the glitz of American entertainment, in a damp field in Watford, England, just outside London. In 1997, twin brothers Steve and Dave Jolliffe were frustrated golfers who hated the driving range experience. They found it boring, solitary, and pointless because you never knew exactly where your ball landed. They had recently sold their mystery shopping business, giving them the capital to try something different. Their idea was to put a microchip inside a golf ball, a piece of technology that experts at the time said was impossible to engineer effectively. The brothers ignored the skeptics and spent 3 years developing a radio frequency identification chip that could survive the impact of a club head traveling at 100 miles per hour. When the first Topgolf location opened in 2000, it looked nothing like the neon-lit party venues we know today. It was purely about the game. The Jolliffes had solved the tracking problem, so players could score points by hitting specific targets. But the British golfing public was largely unimpressed. Traditional golfers didn't care about microchips, and non-golfers had no reason to visit a driving range in Watford. The business struggled to gain traction because it was still trying to be a better version of golf rather than a new form of entertainment. They had the technology right, but the application was wrong. The concept only found its real home thousands of miles across the Atlantic after a chance visit by a group of investors. The concept arrived in Alexandria, Virginia in 2005, but the real transformation happened when the company set its sights on Dallas. The US management team realized that Americans didn't just want to hit balls. They wanted an event. They overhauled the business model completely and shifted the focus from improving your swing to improving your Friday night. They added full-service kitchens, well-stocked bars, and loud music. Suddenly, accuracy mattered less than the atmosphere. The Dallas location exploded in popularity, proving that you could get people who had never touched a 7-iron to pay premium prices for a driving range bay. This was the birth of Eatertainment, a model that would fuel the company's growth for the next 15 years. By 2020, Topgolf was a cultural phenomenon, with venues appearing in suburbs across the country. But it needed deep pockets to keep building. This is where Callaway Golf stepped in. The equipment giant had been an early investor with a small stake since 2006. But CEO Chip Brewer saw a bigger opportunity. He believed that Topgolf was the future of player acquisition. In March 2021, Callaway completed a full merger by acquiring the rest of Topgolf in an all-stock deal that valued the venue operator at roughly $2.6 billion. The logic seemed sound on paper. The plan was to get casual players in the door with beer and wings, then eventually sell them a $500 driver. Investors loved the story and pushed the combined stock price to nearly $40 a share. The problem with the merger became apparent almost immediately after the ink dried. The cooperation executives promised the idea that a Friday night partygoer would turn into a dedicated Sunday golfer simply didn't exist. People went to Topgolf to hang out with friends, eat nachos, and whack a ball into a net, rather than to analyze their swing mechanics or shop for premium equipment. The two businesses were fundamentally different. Callaway was a manufacturing company with high margins and steady cash flow, while Topgolf was a hospitality business with massive overhead that required huge amounts of capital to build each new location. Instead of feeding each other, the two divisions began to pull in opposite directions. If you are enjoying this breakdown of business failures, make sure to subscribe to the channel right now. We cover the biggest corporate collapses and market shifts every single week, so hit that button to keep up with the market. Returning to why the party at Topgolf started to die down, the company had benefited massively from the post-pandemic desire to get out of the house. By 2023, that enthusiasm was fading. Management called it normalization, but the numbers told a scarier story as repeat visits started to drop. The novelty of paying high hourly rates to hit golf balls was wearing off for the casual consumer, especially as inflation squeezed household budgets. Topgolf's revenue model relied heavily on corporate events, where big companies rented out huge sections of the venue for team-building exercises. These events were major profit drivers that generated massive food and beverage sales with high margins. But as the economy tightened in 2024, businesses slashed their entertainment budgets. The 3 or more bay bookings dropped over 20% in some quarters. Without these big corporate checks, Topgolf was left relying on small groups of friends splitting a pitcher of beer. This wasn't enough to cover the massive operating costs of their 65,000 square foot facilities. The high margin, easy money was gone, exposing the fragility of their expensive real estate strategy. Building a Topgolf is not like opening a Subway franchise. Each venue costs between $15 and $20 million to construct and requires massive upfront capital. During the zero interest rate era, borrowing money to build these palaces made sense. But as interest rates climbed through 2024 and stayed high in 2025, the cost of that debt rose dramatically. The return on investment for new venues began to shrink. Adding to the problem, newer locations were often in smaller markets that couldn't generate the same revenue as the original heavy hitters in Dallas or Las Vegas. They were spending more money to build venues that made less profit. Wall Street hates uncertainty, and the combined Topgolf Callaway brands was the definition of uncertain. Investors who wanted to buy a stable golf equipment stock didn't want the risk of a restaurant chain. Investors who wanted high-growth entertainment didn't want a traditional club maker. The result was a conglomerate discount, where the combined company was worth less than the sum of its parts. By mid-2024, the stock had lost nearly 70% of its value from the 2021 peak. Activist investors and analysts began calling for a breakup and argued that Topgolf was weighing down the profitable Callaway equipment business. In September 2024, the rumors were confirmed. The company officially announced a strategic review and stated their intention to spin off Topgolf into a separate, independent company. It was a humiliating admission for the leadership team, who had supported the merger just 3 years earlier. CEO Chip Brewer, who had designed the deal, had to stand before shareholders and admit that the businesses were better off apart. The plan was to execute a spin-off by late 2025 in hopes that Topgolf could operate independently. However, a closer look at the books made it clear that a simple spin-off might not be enough to save the struggling venue operator. Throughout 2025, the situation at Topgolf deteriorated faster than expected. The key metric in retail and hospitality is same venue sales, revenue from locations open for at least a year. For Topgolf, this number turned negative and dropped nearly 9% in some reports. They were opening new locations to hide the losses, but the established venues were emptying out. Customers complained about high prices, since 2 hours of play plus food and drinks easily cost a couple $100s. In an economy where consumers were careful with spending, Topgolf had positioned itself as a luxury that fewer people could afford. By November 2025, the plan for a public spin-off was scrapped in favor of a more desperate measure: a sale. On November 18th, Callaway announced they had found a buyer. But it wasn't another entertainment giant. It was Leonard Green & Partners, a private equity firm known for buying distressed retail assets. The deal structure revealed just how much value had been destroyed. Leonard Green agreed to purchase a 60% controlling stake in Topgolf, leaving Callaway with a minority holding. This wasn't a strategic partnership. It was a rescue mission. Callaway needed to get the debt off its books, and private equity was the only willing taker. The financial details of the Leonard Green deal are shocking. In 2021, the merger valued Topgolf at roughly $2.6 billion. The November 2025 sale valued the business at just $1.1 billion. That is a loss of $1.5 billion in value in less than 5 years. Callaway expects to receive about $770 million in cash from the transaction, which is a fraction of what they originally paid. For long-term shareholders, it was a brutal confirmation that the modern golf experiment had failed. The market had been right all along, since merging a club maker with a party venue was a billion-dollar misunderstanding. Under Leonard Green's control, Topgolf will likely undergo major changes privately. Private equity firms don't buy companies to keep running them the same way. They buy them to cut costs and fix operations. We can expect a drastic slowdown in new venue construction. The focus will shift to forcing profitability out of the existing locations through measures like dynamic pricing, menu changes, and labor cuts. The days of rapid expansion are over. The goal now isn't to put a Topgolf in every city in America, but simply to stop the business from losing money. For Callaway, the separation is a chance to recover. The company will likely change its corporate name back to something that reflects its heritage and drop the Topgolf branding. They can now focus on what they have always done best, making the best golf clubs and balls in the world. Their equipment business has actually remained strong throughout this entire period, proving that while golf entertainment is volatile, the sport itself is healthy. By removing the heavy capital requirements of the venues, Callaway cleans up its balance sheet and becomes a pure-play golf stock again, exactly what their investors wanted 4 years ago. The story of the Topgolf-Callaway merger is a classic case study in corporate overreach. It proves that just because two businesses serve the same customer, it doesn't mean they belong together. The 2025 split serves as a clear reminder that innovation requires sustainable economics rather than just popularity. Topgolf changed the way the world sees golf, but in the end, it couldn't change the basic rules of business. Sometimes, the best way to win the game is to stick to your core strengths.